Hi everyone, it's Nicholas Cup here from Cup Wealth Management Inc. I thought I'd try my hand at this video making thing, and I guess what better way to make a first video than to do it about RRSP, since all this financial services industry buzz right now is about the RRSP deadline. So figured I'd make my first video about RRSPs. Now, generally, all that buzz is really, all the RRSP deadline really means is that, if you want to claim a deduction for your 2016 tax return, March 1st, 2017 is effectively the deadline on when, or the latest you can contribute into an RRSP and still claim a deduction. So, if you don't make an RRSP contribution by then, it's not the end of the world. You just can't use the deduction in the 2016 tax year. You have to wait until next year in 2018 when you file your 2017 tax return. Really, it's as simple as that. And yeah, there's not much more to it than that. But anyway, I thought it'd be pretty cool to, run through a somewhat of a real life example of two different levels of income, a higher income earner and a lower income earner, just to see the effect the same RRSP contribution has in terms of refund that you get based on the different levels of income. So yeah, our two test subjects for today are John and Lisa. And just before we get into it, I do want to give you guys a little bit of a rule of thumb when it comes to, how do I know when I should contribute to my RRSP or whatnot. Generally, what I tell my clients is that, if you're making under $45,000 of income per year, my answer to you would be probably not. If you're making anywhere from 45 to 90, my answer is maybe. And if you're making anything 90 plus, then my answer to you is probably. Geez, Nick, can you be more vague? And I'm not vague on purpose. That's just generally how it is. When it comes to anything, personal financial planning or personal tax planning, there's no one size fits all. It's everything is done on a case by case basis. But I think these thresholds per se gives it a good kind of background on why. And again, the whole point of it is really to get you thinking on when I should start contributing to an RRSP or whatnot. So yeah, let's hop into this example over here. We'll start off with John. John makes $25,000 of income. And the way I set this up, by the way, this is a real tax return, not like a real tax return of a real client or anything like that. It's hypothetical. But the way I set it up is that, pretty much John and Lisa here, all they do is they just make money. There's no other sources of income. There's no other deductions right now apart from the RRSP contribution that we're going to make. And that's that. I set it up so that their balance or refund owing is zero, so virtually their taxes and source deductions were withheld perfectly. And yeah, and just to prove that, I go into John's T4 slip. ABC company lit, $25,000 of income. There's his CPP deduction, there's his EI deduction, and there's his income tax deduction. All right. Whoops. So we're going to give John a $1,000 RRSP contribution, and we're going to see what that does in terms of a tax refund amount. So we go back to the summary, and as we see, employment income $25,000. We see our RRSP contribution right over here of $1,000. That effectively brings down his net income to $24,000. No other deductions. Taxable income is $24,000, and we see a refund of $261. Now, what happened here is that, throughout the year John worked, throughout 2016 John worked. He earned $25,000 of income. His company remitted all of his source deductions perfectly. So it's as if they remitted his taxes as if John was making $25,000 a year. Now he adds a deduction to it, aka the RRSP in this case, which brings his net income down to 24. He's effectively overpaid his taxes throughout the year, because when he's submitting his tax return, he's saying, "Oh, I actually only made $24,000. Therefore, I've effectively overpaid my taxes, and I should receive a refund because of that." And that's why, that's the general kind of reason why people are in a refund position. The opposite is also true. I mean, if you underpaid your taxes throughout the year, you'd have a balance owing, you know. So yeah, that's pretty much it, and we're gonna make a note of that just to keep a little bit of track. Now, I tried to make this video probably 50 times today, so I pre-wrote it just to save some time. But yeah, here we see John RRSP contribution $1,000, tax refund generated $261, as we see in the bottom there, and as a percentage of refund relative to the contribution, that equates to about 26.1%. Tax refund. I think that's fair and understandable. Now we're going to go to Lisa, who's in a who makes significantly more, just to see the effect that it has on her tax return. Before I do that, I'm just going to clean this up and go over to Lisa's return. All right, so here we are. We're in Lisa's return. So Lisa makes $150,000 a year. Similar situation as John, no other income, no other deductions apart from the RSP contribution that we're going to give her in a minute, and that's that. Her employer withheld her source deductions perfectly, so she has a zero balance or refund owing, and that's that. We look at her T4, 150 income, there's her CPP, EI deductions, and her tax withheld. So we're going to go back, we're going to go into her RSP slip and give her a $1,000 contribution, and let's see what effect that has on her refund amount. So again, just going back through it, employment income $150, no other income. There's our $1,000 RSP deduction. That brings her net income down to $149. No other deductions. $149 taxable income, and boom, we have a $464 refund. So, just going back to our note, let's see here. If we compare that to John's, let's get this over here. We see Lisa's contribution, $1,000, refund generated on that $1,000, $464, and the effective rate that she gets is 46.4%. Now, if we compare that to John's 26.1%, that's a significantly higher amount. But, they did the same, they made the same RSP contribution. Both of them contributed $1,000. Why did Lisa get significantly more? Well, that has to do with our, marginal tax rate system. So effectively, the higher level of income you are, the more taxes you pay. Therefore, the deductions that you receive are worth more, per se. And yeah, just to circle back to that threshold amount that I said, or my hypothetical threshold amount, that if you're making under 45, my answer to you is probably not. 45 to 90 maybe, 90 plus probably. Well, just to kind of dig a little bit deeper into it, I have a tax kind of cheat sheet here, and effectively what this says is, this gives you the combined marginal tax rates for federal and provincial in Ontario, and there's our $45,000 threshold. Your taxable income, basically between 45 and under is around 24%. I mean, not really, it's a little bit less. But that being said, your tax burden isn't, it's not that big. You know what I mean? Because your income isn't as high. So, planning or a tax concern taxes is not really that much of a concern. It's not that big of a burden to your financial situation, at least yet. So, it might not make sense to contribute to an RSP. A question that I would ask, a client in this case, it's like, okay, well, did you utilize, do you have TFSA room available? If you have TFSA room available, I would probably do that first. Another reason why I wouldn't contribute to an RSP in this case is, I guess a form of liquidity. Any money that you do pull out of an RSP, you get taxed at, or it becomes taxable. So it's hard to predict your future tax rate and when you need that money for whatever it could be, a purchase of a house, a car, whatever. So I do think we have to put a bit of a premium on mobility there and liquidity, especially if you're young, you're mobile, you don't know if you're going to move jobs, you might have to move out of the city, you might have to move out of the country. That plays a big role on it. So that's why anyone under 45, unless you've really utilized every single tax defer or tax sheltered vehicle in terms of investments or something like that, then I would look at the RSP. But it's not really a first kind of thing that comes to mind, at least in what I would say. Now it gets a little bit tricky for the people in the middle kind of area, from the 45 to 90 bracket, because as your income grows, the tax burden now on the higher end of the scale, the tax burden becomes larger. So if we see any income between 45 and 90, at the bottom end, it's a 29.6, call it about 30% marginal tax rate, versus at the higher end 37.9 or 38%, right? So there's a little bit of a difference there, and on the higher end is where I would start considering what, now it kind of does make sense to contribute, because the tax burden for our investments, it's becoming larger and larger. How do we mitigate that? Okay, we utilize all our tax sheltered vehicles, that, and then what's a tax sheltered vehicle? Your TFSAs, your RRSP, so on and so forth. So that's where it would start to make sense to think about contributing to your RRSP. Another question I would bring up is, what's the type of lifestyle in retirement that you envision? If you envision a lifestyle that is a lower income, so for example, say you're making somewhere in the 80s, but you envision your retirement lifestyle to be significantly less, absolutely it would make sense to contribute to an RSP there, because where you get the maximum benefit from an RSP is you contribute at a high tax, at the highest tax bracket possible, and then withdraw it at the lowest tax bracket possible, because there's two ways of benefiting. You get the tax arbitrage per se from contributing at a high rate and withdrawing at a low rate, and then you get the tax deferred the tax deferred growth within the RSP over the life of that. So that's where it really makes sense, and all that. Now anything above 90, we see here 90 to 140. You're in the 43.5 almost percent marginal tax rate. Taxes is it's going to eat away a good chunk of your return. So this is where, okay, let's start considering what options we have, to shelter our investments from tax and whatnot. And again, that's how I kind of came up with those general thresholds. The 45 and under, probably not. 45 to 90, maybe, and 90 plus, probably. Again, it's very vague and all that. But it really depends on a case by case basis. And just drilling down deeper, for Lisa's situation. So, Lisa made $150,000. She made a $1,000 RSP contribution. We see here her refund amount, was $464, which is effectively 46.4%. I mean, if we go back to that, this 43.41% coincides with the refund amount. Why? Well, 46.41 there. She made $150. And then she made a $1,000 RSP contribution that brought her down to $149. So she's in the marginal tax rate of right here, right? So any income between $140 and change and $150, she's paying 46 cents on the dollar in taxes. Well, it might make sense to contribute to an RSP there, because I envision my lifestyle and retirement to be significantly less than that. That's where it makes sense. I think that's all I really have to say for that. I hope I didn't lose any of you guys. I was kind of scrambling around there. Like I said, I tried to make this video like 50 times trying to get the perfect one take, and I realized that's not going to happen because my skill in video making or editing is virtually non-existent. This is a first for me. So all I ask is to bear with me on that. But again, I look forward to any feedback. I actually really encourage it. I do want to get this up to a regular kind of posting. Do a post once a week or something like that, followed up with a little blog post. And I really hope you guys enjoy it. But please do let me know if you do like it or don't like it. You're not going to hurt my feelings. At the end of the day, I'm here to provide value for everyone in terms of anything personal finance, and would love your feedback. So yeah, let me know if you guys like it. Thank you for listening and all that, and I look forward to the next video. All right, thanks.